Did you know that 90% of day traders lose money? And yet, every year, thousands jump into the market hoping to strike it rich. The truth is, most people fail at investing because they chase quick gains, ignore risks, and let emotions take over. But what if there was a smarter way? Enter Benjamin Graham, the father of value investing. In his timeless book, The Intelligent Investor, Graham reveals the strategies that have helped ordinary people build lasting wealth for over 70 years. His methods don't rely on luck or timing the market. Instead, they focus on patience, discipline, and making smart choices based on the true value of companies. In this video, we'll dive into Graham's key principles, like how to avoid the emotional traps of fear and greed, the difference between price and value, and how to protect your investments with a margin of safety. These are the same strategies that made Warren Buffett one of the wealthiest people in the world. Stay tuned as we break down these life-changing lessons and show you how to apply them to your own investment journey. This is the smart way to invest, and it's easier than you think. Chapter 1. The Investor's Secret Weapon. Patience over luck. Benjamin Graham, in The Intelligent Investor, teaches one core lesson. Patience is a key weapon for successful investing. The market isn't a get-rich-quick game, it's about waiting for the right opportunities. Graham calls this, the patient investor, strategy. The stock market may look chaotic, but if you stick to a long-term plan, the rewards will follow. As he puts it, the investor's chief problem, and even his worst enemy, is likely to be himself. Most investors act based on fear or greed, jumping into markets at the wrong time. But true investors know that time in the market beats timing the market. For example, in 2008, the global financial crisis caused stock prices to crash. Those who panicked and sold their stocks missed out on massive gains when the market rebounded in the following years. If you held your ground, the market rewarded you. That's the power of patience. Graham's principle isn't just about waiting, it's about waiting for quality. He encourages us to find investments that are undervalued. When prices are low, it's a good time to invest, but only in companies with strong fundamentals. The average annual return of the S&P 500 from 1926 to 2021 has been about 10%. While this may seem modest, if you had invested $1,000 in 1926, it would have grown to more than $40,000 by 2021. This shows how the power of compounding, fueled by patience, can lead to massive wealth over time. The lesson here is clear. Patience isn't just about waiting, it's about making smart, calculated decisions and letting time do the work. Chapter 2. The Battle of the Minds. Speculator versus investor. In The Intelligent Investor, Graham makes a clear distinction between speculators and true investors. Speculators are driven by market trends and price fluctuations. They buy stocks hoping to sell them quickly at a higher price. Investors, on the other hand, focus on a company's intrinsic value, its long-term potential and stability. As Graham famously said, the investor is not interested in speculation, but in securing a satisfactory return on his investments. Speculators often rely on gut feelings or market predictions. Investors, however, make decisions based on hard data, research, and analysis. Graham warns against chasing hot trends and getting caught in the fear of missing out, FOMO. Instead, he advocates for what he calls value investing, where you look for stocks that are selling below their true worth. In 1976, Warren Buffett, one of Graham's disciples, bought a textile company called Berkshire Hathaway. It was struggling, but Buffett saw its potential. Today, it's one of the most valuable companies in the world. Another key point is that speculators are often swayed by short-term market movements. Investors know that the market goes through cycles, up and down. Understanding this is essential. In fact, studies show that 90% of day traders lose money. Investors who hold on to quality companies for years, however, tend to beat the market consistently. The message is simple: speculation is gambling. Investing is about understanding value and letting your investments grow over time. Chapter 3. Margin of Safety. The armor against market volatility. Graham's most important risk management strategy is the margin of safety. Simply put, it's the cushion that protects you from losing money. Imagine buying a stock for $100 when its intrinsic value is $150. The margin of safety is the $50 difference. If the market drops, you have a built-in buffer to reduce the chance of losing money. Graham insists that this is critical in investing. Studies show that companies with a significant margin of safety outperform those with little to no margin. In fact, companies with solid financials, low debt, and consistent earnings are far less likely to be affected by market downturns. During the 2008 crisis, companies with a strong margin of safety, like Johnson & Johnson and Procter & Gamble, were able to weather the storm and even thrive. Graham's margin of safety also ties into his principle of buying when others are fearful. When stock prices drop during market corrections, those who are patient and strategic can pick up undervalued assets with a large margin of safety. It's like buying a house for below market value. If the market goes down, you still have room to breathe. Warren Buffett often uses this strategy, buying companies at a discount to their intrinsic value. This margin isn't just about numbers, it's about psychology. When markets are volatile, it's easy to panic. But a well-established margin of safety keeps investors grounded. It's the armor that allows you to sleep well at night, knowing your investments are protected. In Graham's words, the essence of investment management is the management of risks, not the management of returns. If you're finding this video helpful, make sure to subscribe and hit the bell icon so you don't miss any of our future insights into intelligent investing. Chapter 4. The Intelligent Investor's Mental Fortress. Guarding against fear and greed. One of the key takeaways from the intelligent investor is the importance of controlling your emotions in the market. Fear and greed are the two biggest enemies of an investor. Graham emphasizes that being able to think clearly, without getting swept up in the market's ups and downs, is what separates the successful investor from the rest. He warns that most people fail because they react to the market based on emotions rather than logic. Graham's advice is simple. Don't let fear push you into selling during a downturn, and don't let greed make you overpay for an asset during a market boom. Studies have shown that investors who let emotions drive their decisions are more likely to sell low during a market dip and buy high during a market rally. In fact, a report from Dalbar, a research firm, found that the average investor's returns from 1999 to 2018 were only 2.1% annually, far behind the S&P 500's 6.1% return. By creating a mental fortress, an investor can avoid these common traps. The key to this is discipline. For example, if you have a well-researched investment strategy, stick to it. Even when markets are volatile, having a plan in place keeps you grounded. Graham recommends making decisions based on facts and analysis, not market noise. Warren Buffett, a student of Graham's, has lived by this principle. He once said, "The stock market is a device for transferring money from the impatient to the patient." Buffett's long-term approach allows him to ignore short-term market fluctuations, focusing on solid companies with strong fundamentals. That's the mental discipline Graham advocates for: patience, not panic. Chapter 5. Value versus price. Why the market can't tell the true value in the intelligent investor. Graham makes a clear distinction between price and value. Price is what you pay for an asset. Value is what it's truly worth. Most investors get confused between the two. The market price can fluctuate wildly, but the intrinsic value of a company is far more stable. This is why Graham insists that investors focus on value, not price. Graham explains that the market is often irrational, driven by emotions like fear and excitement. This creates opportunities for value investors. For instance, during the 2008 financial crisis, many stocks were priced below their intrinsic value, simply because investors were panicking. This is where value investors, like Buffett, thrived. They saw opportunity when others saw disaster. Let's take a simple example. Imagine you find a stock worth $100, but it's being sold for $80 because of market fear. If you can buy it for $80, you're getting $20 in value for free. Over time, as the market corrects itself, the stock's price will reflect its true value. This is a powerful strategy that Graham calls buying undervalued stocks. To identify these opportunities, Graham recommends doing thorough research on a company's financials, including earnings, debt levels, and management. He also stresses the importance of looking beyond short-term market trends. By focusing on the company's intrinsic value, investors can find stocks that are selling for less than they are worth, giving them a margin of safety. Over the long term, stocks priced below their intrinsic value tend to outperform those bought at market price. Historical data shows that stocks with low price-to-earnings (P/E) ratios have consistently outperformed the broader market. In essence, if you focus on value, you are less likely to be caught up in short-term market hype. Chapter 6. The Investor's Roadmap. Building a portfolio that outlasts the test of time. Building a strong, long-term portfolio is one of the most important strategies discussed in The Intelligent Investor. Graham suggests that investors should diversify their portfolios to reduce risk. He recommends balancing stocks, bonds, and other investments based on your personal risk tolerance and financial goals. Graham's ideal portfolio for most investors is a mix of 25% to 75% stocks, with the remainder in bonds. This balanced approach allows investors to benefit from the growth potential of stocks while still maintaining the stability and income provided by bonds. Over time, a diversified portfolio can smooth out the inevitable ups and downs of the market. Let's break it down with numbers. Between 1926 and 2021, the average annual return of a diversified portfolio consisting of 60% stocks and 40% bonds was around 8%. While this is lower than the returns from stocks alone, it's much less volatile. This means less risk for investors, especially those who are nearing retirement. Graham also recommends rebalancing your portfolio periodically. This means adjusting the allocation of stocks and bonds to keep your portfolio in line with your risk tolerance. If stocks have done particularly well, you might need to sell some and buy more bonds to maintain your desired balance. This helps keep your portfolio stable, even during times of market uncertainty. A key part of this strategy is being realistic about your returns. Graham notes that most investors should expect average returns over the long term. He warns against chasing extraordinary gains, which are often the result of speculation, not investing. By sticking to a balanced, diversified portfolio, you can weather market storms and steadily build wealth over time. Warren Buffett's famous advice aligns with Graham's principles: our favorite holding period is forever. A long-term perspective ensures that you don't panic during short-term market fluctuations. By staying invested, diversifying, and rebalancing, your portfolio will not only withstand the test of time but will likely thrive. Thanks for watching. Don't forget to subscribe and hit the bell icon so you can keep up with more tips on smart investing and building wealth.